Coca-Cola, one of the big movers today, topping earnings and revenue estimates. The company reiterating its full-year forecast, but did say the overall macroeconomic environment remains challenging. CEO James Quincey joins us now. James, it's good to have you on an earnings day. Stock's up nicely, almost 4%. I mean, organic revenue growth of 6% is higher than what we're seeing in the industry right now. Talk about what you're seeing from consumers around the globe.
Look, we're seeing the strong results from Coca-Cola because we're basically investing in a great industry. We're the leader and we're gaining share. And what we've been able to do is to adapt to the different dynamics that consumers are facing. You can see that in the U.S. With the kind of the higher end of the income pyramid, still got lots of spending power, still outspending, and you see growth in the channels and the products they're most interested in. But you do see the lower income consumers under pressure, doing some value-seeking behavior, whether that be channel or the pack sizes or the price point. You see some of that in Europe too. So there's a difference across the world. You see some economic sluggishness in parts of Asia, but overall, aggregate consumer demand is there. And we've been able to drive that and turn that into a good result for the Coke company.
Why then aren't we seeing more volumes? I think 1% overall volumes flat in North America. Why not the kind of volume growth that you want to see?
I think what we saw in this quarter, yes, I certainly would like to see more volume growth. In our algorithm of the total company, we expect to see more of the volume growth come from more of the emerging markets. And what we saw in the third quarter, a bit of a similar trend to the year, is some pressure in some of the key emerging markets for us. India was below our expectations, a lot of early monsoon action and some local dynamics there. China didn't come in as strong. While Coke grew, we underperformed and didn't get the volume growth we wanted in China, and also some of the ASEAN markets. So there were some weaknesses in our emerging markets that should drive volume growth, that certainly have driven volume growth in the past, as well as some issues in Mexico. So I think those will revert themselves from a macro point of view. And of course, we're taking actions ourselves to really focus in on the things that can be done, that we can control, to drive a better result in those markets going forward.
A lot of the growth, is still coming from this price mix, is what the industry calls it. I noticed that in North America, price mix grew 6%. How should we think about that? Is that inflation, or is it smaller packages? What does it actually translate into for consumers?
I think it's easiest to think of it in two buckets. One is price and one is mix. So you see price, which is actually about 4% of the 6%, which is much closer to inflation. And then the other 2% is actually a function of the mix of categories. So what it means is the products like Fairlife, Core Power, Topo Chico, Smart Water, Diag, the ones that have a slightly higher price than average have been growing faster, and so they produce a mix effect because of their higher growth rates, because they're being bought by the higher income consumers. And so it's really a feature of the channels and packages that grow faster. And in this case, it's the ones that tend to be more premium that have done better, both the channels and the products. And so you get that 2% price mix effect. So the easiest thing is to think that that's not a permanent feature over the long run. And the price, which was 4, is much more likely to track inflation. That's the easiest way to think of the U.S. marketplace.
So it's so interesting because we hear a lot about the consumer split right now, high income versus low income. You're saying it really splits across your portfolio, where certain products like a Fairlife or Topo Chico do better because they're more exposed to the high income consumer?
Absolutely. And you also see that in the channels. So you see growth in the value channels, the dollar store channels, but you also see growth in what would be the more premium channels, the higher end restaurants, fast casual. So you can see that in the channel mix as well, the amusement channel, and so that effect can be seen across products and channels.
Who are you gaining market share, and where are those gains coming from in the portfolio?
Globally, we're winning share overall. We've got many years of winning total share. What generally is happening is the Coke trademark is doing well, and then we're gaining in some of the premium segments, particularly the ones where we got great brand strength from the new up-and-coming things like Fairlife, or even ready-to-drink teas, which grew strongly, for example, in the U.S. This quarter. So we're making advances across the portfolio. It's not everywhere and is roses, so there's still a lot of work to be done. We can still be better. There are still things we have to correct, and that gives us the belief that not only is the industry going to keep growing, but we've got lots of things we can do better ourselves.
You have a good feel for the consumer in China, James. I'm wondering what you're seeing there on the ground as we saw, weaker growth numbers reported this week.
Yeah, our sense on China is that there is pressure on economic growth and pressure on the consumer. I think the macro numbers are pretty clear that the investment is driving kind of the sectors that are non-consumer led in the Chinese economy, and they've been trying to rebalance a little more to the consumer. It's not getting as much traction as I think they're looking for, and we are a microcosm of that. But of course, no CEO is going to say to their operators in China, okay, then you don't have to grow. No, we need to focus in on what we can do best. And as I said earlier, Coke was growing volume and revenue in the third quarter in China, and we need to do a little better on some of the other brands. But it is in a general environment where it's a little more subdued.